So I've been pessimistic since the advent of Trump's crazy tariffs, and I've been very public saying that I thought these tariffs were a disaster from the get, and I feel like I've seen some similar stuff from you.
So, yes, stuff's bad, very bad. There's no way to sugarcoat this. And also, it's not the kind of thing that can quickly snap back either.
Yeah.
Just like Trump came in and immediately broke the transatlantic alliance in ways that would take many decades to repair, he's broken the United States' position in the global economy in ways that will take also decades to repair, if we can ever do it. Probably we can never get. We're breaking things that we'll never be able to get back. Things that were built on an inheritance of policy and economic relationships from the end of World War II onward that now we will not be able to restore because the conditions that allowed us to build those in the first place will never return. So there are certain, good things about the American economy that we knew 6 weeks ago that you won't see again in your life. You and I will die before we ever see those again. And that's what has happened now. It is an object lesson in the principle of fuck around and find out.
In one of your blog posts, you say, hey, most Americans don't understand the global finance system or the bond market. And you likened it to a giant dragon that we're all sort of riding around on the back of. So what did you mean by this sleeping dragon?
The U.S. bond market is much larger than the stock market. And the point is that people think it's supposed to be not very risky. You invest in stocks. Stocks are a risky asset. It's supposed to go up, go down, blah, blah, blah. Bonds are supposed to be rock solid. And U.S. Treasury bonds have been treated as a risk-free asset for decades. Banks, what banks make money by borrowing and lending, right? And then some of those loans are risky loans and some of the loans are safe loans. And the safe loans act as ballast that prevents the bank from going under if some of the risky loans go bad or if people pull their money out, et cetera. Treasuries are the safest of safe loans, or were thought to be. And so banks would park their money in treasuries to make themselves safer. And when you have, for example, capital adequacy rules, what does that mean? That means that you have to basically have a bunch of safe assets around to sort of back up your risky lending. You have to be able to cover those loans. And of course, you do that with treasuries. Now, if treasuries have become a risky asset, that doesn't work anymore and our banks are insolvent, right? Because they skate on banks will now skate on the edge of insolvency that were previously rock solid. Okay. And when the bank system gets screwed, you remember the Great Recession, right? We lived through that. We can see what happens when banks stop lending. So then bond markets are based on treasuries as well in more complex ways. You use treasuries as a sort of like riskless asset to, you can lend and borrow treasuries as this sort of riskless thing that you use to finance various trades in the bond market. When there's a risk premium on treasuries, which means that people will not invest in treasuries unless you pay them extra yields. Yields are interest rates. That's what that means. And then those go up. And so when you have, a risk premium in treasuries, which means people no longer see it as a riskless asset. People see it as a risky asset, and they start charging you higher interest rates to lend to treasuries. Well, then interest rates then go up on corporate loans and mortgages and all these other things. And companies find it harder to borrow, companies borrow to invest, they borrow to expand, they borrow to fund their everyday operations. And now they find that a lot harder. And then mortgage borrowers find it harder to borrow to get a house. And so now we're seeing mortgage rates go up from this new risk premium on treasuries. And so we're seeing those things at the same time as we see other things in the international market, such as the decline of the dollar. We can talk about that more. But the point is about the bond market. If it starts getting harder to borrow money in America, a lot of the things that we rely upon for our prosperity, for our daily economic, stuff disappears. And it gets a lot harder.
So you have seen his numbers suffer as a result of this. I mean, yes. We're not sure how much bearing that has, but the last reporting I saw said that his approval rating has gone down by about 7% as a result of these tariffs. So you say that we're at the beginning of the beginning, not even the end of the beginning. It sounds like you have something of a vision in store. It's almost like a story where the dragon wakes up or something goes on. So if you think we're in like the first or second inning and obviously not holding you to it because no one has a crystal ball. But what are you concerned about moving forward?
Further capital flight will be a big problem. Further capital flight will raise interest rates because what happens is that people sell American bonds and then they don't believe these bonds are safe anymore. If that happens, if that continues to happen, what does Trump do? So the national debt gets a lot harder to pay.
Yep.
The interest that we have to pay on the national debt as we roll over our bonds at higher and higher interest rates becomes harder to pay. It's already near historic highs right now. And that was just from the Fed raising interest rates. But now, if you add a risk premium to treasuries, the amount of interest that we'll have to pay is very high. Especially because we responded to the very high interest rates, or the high interest costs. We responded to that by issuing a whole bunch of very short-term treasuries, assuming interest rates would go down as inflation subsided and the economy normalized. That's turning out to be a very bad bet, but it's a short-term bet. In other words, very quickly, we will have to refinance a lot of that debt at very much higher interest rates. So interest costs for the federal government are going to go way up, way fast, okay? And then what happens then? So number one, we simply cut spending and tighten our belts and do austerity and raise taxes. But Trump and his people and the Republicans are talking about massive amounts of tax cuts. And they certainly don't have the political wherewithal to cut spending, and they don't even appear to want to cut spending. They're just going to do more tax cuts, make everything worse. So how do you pay the national debt? There's two ways. Well, there's two things you can do, and they both closely parallel things that Trump has done in his business dealings. The first thing Trump would do when his businesses were underwater is look for a bailout, look for someone to invest a whole bunch of money in him, give him a bunch of money, right? And so there's only one, now that foreigners won't give us money, there's only one entity in the world that can bail out the United States, and that's the Federal Reserve.
Yeah.
So Trump will try to lean on the Federal Reserve to print money and use that to buy American debt to force the interest rates back down. What happens when you print a bunch of money? Well, sometimes, as in Japan, you had the Japanese central bank print a bunch of money and buy government debt, and not much happened. Interest rates stayed low. All the money stayed in the country. I don't think that's what's going to happen with us. I think we're going to get inflation from that. I think that when you print a bunch of money and use that to buy treasury bonds with high interest rates, you're going to get inflation. You're going to get more capital leaving the country. You're going to make the situation worse. You're going to make prices worse. You're going to make Americans' real incomes go down, and you're going to make the markets go down, continue to look bad, of course. More people get laid off, and so you'll get stagflation, but also you'll just get some of the sudden erosion of purchasing power, buying power, income, real incomes that we saw during 2021, 22, except now it'll be self-inflicted. Well, I guess it was partially self-inflicted before, but now it'll be pretty much entirely self-inflicted. And so that's, if Trump decides to force the Fed to somehow try to bail out the US government, I believe inflation will be the result. And I believe that the efficacy of this policy will be relatively limited. And the other thing Trump would do in his business dealings is, if bailouts didn't work, he would declare bankruptcy. Trump has declared bankruptcy in his own businesses many times. If you declare bankruptcy as a country, what is that? That's called a sovereign debt default. And
the U.S. defaulting on the debt would be absolute madness.
Right, that's right. But I believe that I'm very sure that I'm not very sure. I'm reasonably sure that you're going to start seeing Trump talk about this or make noises in that direction fairly soon.
Well, to try and force the Fed's hand to do option one, you would think.
Probably. That's right. And then, but I think you're going to start hearing talks about a sovereign default.
Hey YouTube, thanks for watching. Please do hit like and subscribe, and hit that bell if you want to be notified every time a new episode drops. Thank you.